Hello, this is Mark Sobel, U.S. Chair OMFIF, and I'm a member of the Bretton Woods Advisory Council. Today, OMFIF and the Bretton Woods Committee are co-hosting this event, and I'm delighted to welcome Bill Dudley, the chair of the Bretton Woods Committee, for a discussion about yesterday's FOMC outcome and monetary policy more generally. As you know, Bill was formerly president of the New York Fed from 2009 to 2018, and before that, the manager of the markets desk when I had the pleasure to first get to know him. He's one of America's foremost leading monetary policy experts and gurus. I plan to ask Bill some general questions for the first 20 minutes or so to get his views on the table. I'll then turn to two colleagues and friends to kick off the audience discussion with some brief thoughts, observations, and questions. They'll join us then. Sonal Desai, Executive Vice President and Chief Investment Officer for Franklin Templeton Fixed Income. Vince Reinhart, Chief Economist and Macro Strategist at Dreyfus and Mellon, formerly inter alia Director of the Division of Monetary Affairs at the Federal Reserve, as well as a Deputy Director in the Division of International Finance. After that, I'll turn to the audience. Questions can be submitted in the chat function. Welcome, Bill.
Great to be here.
So, Bill, you were in the 50 basis point cut camp. You must feel happy and vindicated. But let's just start with the obvious. Just top line reactions to the result, the statement, the dot plot, Powell's press conference, and we'll drill down after that.
So I think the logic for 50 goes like this. The dual mandate objectives of the Fed, full employment, price stability, had come into better balance. And Powell basically said that at the Jackson Hole conference. If you believe that premise, then monetary policy should be in a neutral setting, not tight. Yet everyone would agree that the current setting of monetary policy is far away from neutral. I think the lowest federal funds rate, the very top of the range of what Fed officials think is neutral is probably like 3.8%. So the Fed's a long way from neutral at a time that they probably should be at neutral, and so that created a logic that the Fed should get going, a little bit more aggressively than just doing 25 basis points. And I think that's where Powell came out. And I think what happened was he brought the rest of the committee along with him. If you look at the summary of economic projections, the so-called dot plot, what's interesting is that there's quite a few people that only have another 25 basis points penciled into their forecast. So I'm sort of the view that they probably went into the meeting hoping for 25, and then they were planning to do another 225s. But now that they've done 50, there's only 25 basis points left in their forecast for the rest of 2024. I think the committee is, pretty united about, why we're doing this, and it's just a question about, pace and speed and message. I thought Powell did a great job yesterday, sort of explaining this in a, non-scary way. I'm not doing this because the economy is falling apart. I'm not doing this because I'm really worried about the downside risk to the labor market. I'm doing this because the dual mandate objectives have come into better balance. Essentially, we're in a good place. Economy's doing well. But this is a way to make sure that we can keep that going.
Okay, well, thank you for that. Well, let's drill down a little bit. First, the economic outlook, how you see it. So let's just start with inflation. I always get lost amid all the myriad measures, but it seems as if we're close to the 2% targets. Oil prices are heading down. Housing doesn't seem to want to come down, but everybody thinks it will. So are we pretty much back on target, and is inflation really in the rear view mirror?
Well, we're not quite to the Fed's 2% objective. I mean, if you look at the core PCE deflator, that's running around 2.5%. So, but it looks like inflation is going to continue to come down a little bit further because some of the components of inflation that are still, a little bit more sturdy, like shelter and insurance costs, those look like they're lagging indicators. Shelter inflation lags what's happening to rents. Rents have stabilized quite a while ago. And so as Powell was asked about that yesterday, he said he does expect shelter costs to continue to come down as we look further out. The other thing that's going to help the Fed is when we get to the first part of next year, the inflation comparisons compared to a year ago are going to be a lot easier because we got some really bad numbers, if you remember, at the beginning of this year. So the base effects are going to work in the Fed's favor. So I think the Fed is, pretty confident that they're going to achieve their they're going to get very close to their 2% objective. I think where they're a little bit more concerned is about the softening of the labor market. And Paul, threw out a whole bunch of different indicators of labor market softness. 3-month change in payroll employment, the weakest it's been since 2020. The ratio of unfilled jobs to unemployment has come down from 2 to 1 to 1 to 1. Quits ratio has fallen. Wage inflation's come down. So I think the Fed is a little bit worried about and the unemployment rate, of course, has gone up. So I think the Fed is worried about the unemployment, the labor market side of the equation. And that's really what's motivating the 50 basis point cut. They don't want to see any further weakening in the labor market, but it has been weakening, and so there is a little bit of risk that the labor market deterioration continues. And if that were to happen, then the Fed would continue on this sort of a more aggressive path.
Well, on that point, there were those who said that the reason they went for 50 is that they're afraid of perhaps recessionary tendencies, but others emphasize catch up for July, risk managements, or insurance for a soft landing. The dot plot says 4.4, 4.4. Sometimes I think in history, unemployment shoots up. Is it realistic to say for the Fed just to keep the outlook at 4.4?
So Powell was very clear that he did not think that recession was very likely, that he thought the labor market was still doing okay and that the economy was, holding up quite well. But, if you look back historically, when the unemployment rate goes up beyond a certain threshold, almost always the U.S. economy falls into a full-blown recession. This is a SOM rule. So the SOM rule basically says if the unemployment rate goes up by more than 0.5% on a 3-month moving average basis from its low point within the past 12 months, every time you've actually had a recession. And this threshold has been triggered. Now that doesn't mean this threshold necessarily is going to work this time. But the SOM rule, I think the other part of the SOM rule that people don't put enough emphasis on is what happens when you go through that threshold. The next stop is a much bigger rise in the unemployment rate. So there's no examples of the unemployment rate rising just 0.75 percentage point or a 1 percentage point or 1.5 percentage point. It either rises fairly trivially, or you actually get a full-blown recession. And that's really the risk, the downside risk right now from the Fed's perspective. Powell is not worried about the SOM rule threshold being triggered. His view is that the rise in the unemployment rate is due to rapid growth in the labor force. So it's not that people are getting laid off. It's basically that new entrants into the labor force are having trouble finding jobs. We'll see if that difference matters. My own personal view is there are some risk of a I wouldn't say hard landing, but a mild recession. And from my perspective, Federal Reserve should be taking out some insurance about that. If you look at the summary of economic projections, everyone usually focuses on the forecast and the dot plot. But if you go deeper into the summary of economic projections, they actually have an assessment by Fed officials of the balance of the risk. And what was interesting this time compared to June is the balance of the risk had changed for both inflation and the labor market. For inflation, the upside risk to inflation had diminished a lot. And then for the labor market, the upside risk that the unemployment rate was going to continue to go up and increase significantly. So the Fed basically, I think at this point, is pretty comfortable about inflation, has some concerns about the labor market weakness continuing and maybe even intensifying.
Thanks. Let me ask you about your rate outlook for the rest of this year, 2025, on the Fed funds. Where do you see the Fed ending up? I saw 2.9 is their projection of neutral, and then any views on market pricing? Is it too aggressive or not?
Yeah, I mean, I think I don't think you want to be very confident about what the Fed's going to do in terms of the trajectory of interest rates, because it is going to be so much determined by how the economic data evolve. I mean, yeah, the Fed wrote down this forecast yesterday, but take a look at past summary of economic projections forecasts and what's actually happened. There can be very, very big differences. I think that the forecast for this year, I would expect that the baseline is probably they do 25 at the next two meetings, assuming that the data is sort of similar to what we have right now. But of course, if the labor market keeps deteriorating by more than what they have penciled into their projections, rise in the unemployment rate to 4.4%, then I think you could see another 50. Now, looking further out, there's really sort of two broad set of issues. One, what's neutral? And Powell said yesterday they thought that R star, the level of R star, was higher than it was following the great financial crisis. But there's a lot of uncertainty about what R star is. Just look at the Federal Reserve officials. The range for R star is 2.4% to 3.8%. So that's a pretty broad range. So that's the first issue. Where's R star? I agree with Powell that it's probably higher than what it was following the great financial crisis. So I'd probably pick a number like, I'd probably be at the upper end of the Fed's forecast. 2.8, might be my perception of R star. And the second question is monetary policy just going to go to neutral, or is it going to actually have to go to easy to arrest further deterioration in the labor market? So the Fed's forecast is a soft landing forecast. I mean, if you look at the summary of economic projections, that's the Fed eases monetary policy. The labor market's pretty stable after a little bit of a further deterioration this year. Inflation comes down. Economy continues to grow over the next couple of years. That's the Fed goes to R star. But if the economy is weaker than this, then the Federal Reserve is going to have to go to an easy monetary policy, and then you get a lower interest rate. Markets are priced to the federal funds rate falling to a little bit below 3%. If you look out over the next couple of years, but that probably includes a weight on both of those scenarios. Scenario one, that we don't have a recession and the Fed goes to 3.5, or we have a recession and the Fed goes to 2 to 3. So markets, what we see in the federal funds future markets reflects some combination of those two outcomes. I think what the market's not putting a lot of weight on is the notion that inflation is going to resurface and be a problem, and the Federal Reserve is going to actually have to keep monetary policy tight over this extended period. Mark, you seem to have frozen.
So, Bill, in the interim, can I ask you a question?
Sure, of course.
So, from your perspective, the Fed did the right thing. Did they do it for the right reasons? When you look at the statement, when you look at Powell's press conference, which I agree was quite good, and the SEP, are they on the right page to do the right thing subsequently, or did they in fact get bullied by markets?
I don't think they got bullied by markets. I think what happened was that Powell wanted to do 50, and probably there were quite a few people on the FOMC that were thinking 25 basis points. And you can see that in the summary of economic projections, where the fact that there's so many people. I think there's like 9 people that have either zero more, only have one rate cut, in the remainder of the year. So that tells me that Powell wanted to do 50, and he brought the committee along with him, with the exception of obviously Michelle Bowman, who was the first governor to dissent, I think, since 2005. But my personal opinion is, it's not that important whether they actually did 25 or 50. What really matters is where they're headed, and where markets think they're headed, especially because where markets think they're headed determines what's happening to the bond market, what's happening to the stock market, what's happening to financial conditions more generally. And it's that easing of financial conditions that ultimately provides support for the economy and prevents the labor market from deteriorating much further.
Can we split that in two? There's two parts: where markets are headed, and where the Fed's headed, and where you think markets think the Fed is headed. So you think they're headed for the right place. A feature since October 2022 has been markets have been overeager in expecting policy ease. If Powell is dragging his committee along, is he gonna be running into trouble for the rest of the year and into next, with markets just expecting more than he can deliver?
That's certainly possible. I think that markets, as you said, they're pretty aggressive in the near term. I mean, if you look at what's priced in through, the end of the year, it's actually more than 25 and 25. It's 25 and, some probability of 50. And I don't think that's really where, if you look at the Fed's dot plot and what they're projecting for the rest of the year, that's not their forecast at this point in time. So, but remember, the market's also focusing on, the range of potential outcomes. And, I think, given the deterioration that we've seen in the labor market, you have to realize there's some probability on the risk of a mild recession. And I think the markets put some weight on that. End of the day, I mean, I don't really worry too much about this because Fed's going to do what it does and markets are going to be forced to adjust. The fact is the Fed has signaled pretty clearly that we're going to ease monetary policy. And now, we're all going to take this journey together and where we go is going to be driven by, mostly by the economic data. Also, remember too, that the summary of economic projections is always sort of an optimistic set of forecasts because you're told when you're writing down your numbers for the summary of economic projections, you're supposed to write down the optimal monetary policy forecast. Now, the reality is we don't really actually know what the optimal monetary policy forecast is, given how the world's actually going to evolve. And so the summary of economic projections is sort of like the best case of how things are going to evolve.
It's a terrible mechanism for communicating because it's modal forecast, and so it doesn't take your downside risk. And I hear Mark is back, and so why don't we turn back to him?
Well, I thank you and Sonal for stepping in. So just two more quick questions for Bill. Quick. One, just something that's been on my mind. When I look at the debt GDP ratio, it goes from 100 to 125 over the next decade. But then I look at the implications for the annual deficit, 6-7% of GDP is what CBO is forecasting. And that seems to me like to be a lot of paper that the markets will have to absorb, which will have implications for interest rates for sure. I mean, do you see a rising term premium that slows growth, or do you think that this is really going to be hard to digest and it could overwhelm markets and we could see huge financial ructions as a result?
Well, I mean, I think it's straightforward that if you're on an unsustainable trajectory, eventually it's going to come to an end. And the question is, when? I think in an environment where the economy is, slowing and the Fed is easing, it's probably not the period of time where all of a sudden the bond market vigilantes, return and say we're not going to finance this. But you're absolutely right. I'm very concerned about the fiscal trajectory, and I'm also very concerned that the two candidates that we have running for president don't seem to be very concerned about it at all. So not only are we on an unsustainable course, there doesn't seem to be any political will to actually do anything serious to address this. So I completely agree with the premise of your question that we're going to have a problem at some point. The question is when. And that could be, 6 months down the road, or it could be 2 or 3 years down the road. And, I think that's really hard to forecast. When the budget deficit starts becoming an issue, it will be, an issue that will tend to accelerate pretty quickly, right? Because if bond yields go up, then the government's financing costs go up. Therefore, the deficit goes up further. So I think what will ultimately happen at some point, markets will balk, and that will finally put the pressure on the politicians to do something to address what's an unsustainable fiscal path. And that's what happened. That's what happened in the 1990s finally when Bill Clinton came in. The bond market vigilantes were out in earnest, and the Clinton administration actually did tighten fiscal policy as a consequence.
All right, my last question for you is a very simple one, but I don't get hold of you all that often. So the Fed's going to start a framework review. What's your top-level views on what the Fed should do in this framework review?
Well, I have a whole bunch of things that I would do in my framework review that I don't actually think the Fed's going to do. I think they'll keep the 2% average inflation targeting regime mostly in place. I think there'll be quite a bit of discussion of maybe moving the target from 2% to a range, 1.5 to 2.5. I think that'd be a reasonable thing to do. I think the big change they're going to make is bring back, make it very clear that monetary policy in the future is going to be preemptive again. The big mistake of this cycle was the Fed sitting on their hands, even as the economy was overheating and we're moving, well beyond full employment. I mean, you think of it, March of 2020, March of 2022, the Fed was still buying securities and interest rates were at zero as the economy was accelerating and inflation was way above the Fed's target. So I think that will change. A number of things that I'd like to see that I probably won't see is one, a real review of quantitative easing and quantitative tightening. I feel like the Fed this last cycle has done this sort of by the seat of the pants. They don't have a framework in terms of evaluating the benefits and cost of quantitative easing, quantitative tightening. And, there is a real cost. I mean, the Fed has a hole in its balance sheet now that's almost $200 billion caused by the imbalance between the cost of their funding versus the return they're getting on their assets. And that was all created by quantitative easing. Another thing I'd love to see them do is actually talk about, do we actually need the federal funds rate as our target? If you think about the reverse repo facility that they invented, that was put in place just to ensure that the Federal Reserve, the federal funds rate would stay within its target range. We don't need the federal funds rate as a target. The Fed can just set the interest rate on reserves, and that can be the tool of monetary policy. So having the federal funds rate as a target, in my mind, introduces unnecessary complexity. And the last issue, and a number of people have advocated for this, is to raise the inflation target from 2% to a higher number, maybe 3%. I think that's a terrible idea, and I'm absolutely convinced that the Federal Reserve will not do it. They won't do it because they got huge benefits this cycle by having inflation expectations well anchored at 2%. And if you change the inflation target, you will unanchor those inflation expectations, and that would be a big thing to give up. And the second reason I don't think they'll change it is Congress sets the mandate for the Fed. I mean, Fed has independence about how they conduct monetary policy, but the Congress sets the goals. And the goal is price stability and full employment. Fed has stretched that definition of price stability to 2%. You tell me how that can justify price stability at 3% or higher.
Great. That is a great overview. Let me call on our discussants, Sonal. And Vince, please join us. Sonal, let me let you kick off, and thanks to Vince and you for subbing for me.
Really, it was Vince. Actually, I wouldn't mind asking a question myself rather than giving comments. I largely agree with most of what Bill said. Perhaps I'm a bit more on the side of a higher neutral, but totally agree that you can't see that neutral. IMF just came out with a paper, which I find myself very much in agreement with, where they've gone back and they've looked at the whole COVID episode, and they look at the US and Europe and say that, in fact, it was less about supply side shocks and a lot about fiscal and monetary policy. So given where we are sitting, and given that the last couple of administrations have completely blown up the budget, and it's quite likely that in the first half of next year, we're going to see more of the same as a new administration, whichever colors they wear, comes in. Doesn't this impact your view on what the Fed can or should do?
I mean, obviously, if we come in next year and there's a big, fiscal expansion, that's obviously going to change the trajectory of monetary policy because it'll change whether the Fed needs to be neutral. It'll also change the level of R-star, which are sort of intimidating. So I think I completely agree with you. I think the Fed at this point, though, isn't making any judgments about what's going to happen next year, because obviously the election hasn't been decided. And, we're going to also have a House and a Senate that's probably, very narrow margins. So just because you want to do something doesn't mean you actually can do it. And finally, a lot of this is pandering, right, of both candidates to the voters. I mean, when you think about it, we're going to exempt overtime from taxation. We're going to exempt tips from taxation. We're going to do all this stuff. This is all about just trying to get people to vote for you, not I don't think serious things that are going to actually translate into legislation.
I took a lot, if I can just follow, I took a lot more comfort from the idea of a split administration and Congress and Senate, before the last 2 years. We had the split, administration, and somehow they managed to get away with massive expanses in the fiscal deficit anyway. And that's why I have some concern on that front. But I'll stop here and hand it over to Vincent.
Vince.
Sure, thank you. Let me just make a few remarks. And the first is just have very modest differences in with Bill in terms of the need for 50 basis points at this meeting. And it really is about inflation, particularly the persistence of inflation, as Bill noted. Inflation, some components, the service parts of the price basket have shown remarkable persistence. What do you take from that? Well, what I hear from Powell is that means they'll stop real soon. Well, I worry that the fact they've been persistent for a while may mean they'll be persistent for a while more to come. And we're still above 4% in terms of the sticky price component of the price basket. And the second part is the other 30% of the price basket goods. The world's a risky place. And a part of the disinflation in 2024 has been the fact that goods prices have basically been unchanged on net. I'm not sure that we should count on that over the next year. And so that I have an upside risk associated with that. However, there really are two things that temper the consequences of our modest disagreement about the economic outlook. And the first is, the policy action just doesn't really matter all that much. It's just the overnight federal funds rate. What the FOMC does is announce a package, what it does with the policy target, what guidance it has for the future path of rates, and how strong it expresses conditionality, how it would deviate from that guidance if events turned out differently. And the fact is, Powell executed well. If 50 basis points was somewhat dovish relative to where everybody was just before the meeting, he tempered that and really did express well the conditionality of the policy action. Now, my chief concern really is on my side of the table now, not where I used to sit, and that's about markets and investors. Since October of 2022, investors have been ahead of themselves, always expecting that quick pivot by the Fed, a pronounced cut in rates, really the Fed to break the glass and go to emergency policy action. 50 basis points risks feeding the beast. And the Fed is going to have to work hard to make sure that investors don't expect too much additional policy action. And as we talked before, I think that could be a problem if, as Bill suspects, Powell's ahead of his committee in wanting to continue to ease monetary policy. His job will be harder if investors want even more than he can deliver. But one qualification there is there were two notable surprises yesterday. The one sort of modest, they went for 50 basis points instead of 25. Actually, in half the easing cycles in the modern era, the committee started with a bang, did a bigger action. And that's because because in those cases, they were responding to events. This was planned, and so if you have a plan, you probably can execute it in small bites, which I take then as 50 basis points being some element of a catch-up. But the other part of the surprise is that it was a surprise. In the Powell era, we know what the FOMC is going to do a couple days or a couple weeks, most often, in advance. He squashes any doubt about the committee action even before the blackout curtain drops. I think it's because we think of 2:00 that Wednesday as the FOMC statement release. Powell thinks about it as a half hour before his press conference, and he doesn't want a big market surprise to shape what the what that press conference, what reporters will ask, and the risk of red numbers underneath his picture on TV. So why was there a big surprise? I hear Bill to say, well, it was because the committee just doesn't agree, and he had to herd all those folks together. I also think it served his interest because he's shown himself to be a pretty effective and relatively imperial chair. The fact that it took a while to get together and that they were still deliberating as the blackout curtain dropped really underscores that it was a group effort, that it wasn't the captain who turned the boat. It was the FOMC as a group decided to change policy. And that's useful if you're going to do something in which the institution is criticized. And so I think that governance aspect is interesting. And then I guess I'll stop here, although Mark.
Oh no, thank you. Bill, any reactions? Or Sonal, any further questions having listened to Vince and then back to Bill?
No, I'd actually just echo one thing that Vince said, and relating it back to something Bill said earlier, the fears of a recession. As far as the market's concerned, I look at spreads on high yield debt. I look at spreads on bank loans. We are close to pretty much all-time tights. So the market is playing the Fed. It's not playing fears of recession. That's something I would just lay down there, because there is no typical recession, but pretty much any recession in this century and clearly the high yield market has changed enormously. But we've been looking at spreads up to and over 1,000 basis points. We're looking at something between 325, 350 right now. I think this really echoing what Vince said, the Fed needs to be extremely careful that it doesn't generate and fuel another run on markets, of markets which are already trading with a great degree of exuberance, notwithstanding some sell-off.
To Sonal's point, the fact is, other risk markets have not gotten the memo in Fed funds futures for the last 2 years. Fed funds futures have been pricing at the Fed's emergency response to economic weakness. It isn't in implied volatilities. It isn't into equity prices. It isn't in risk spreads. So that disconnect is disconcerting.
Yeah, just say that's recency bias since the global financial crisis.
I completely agree with your point that the trajectory of the funds rate is to a level suggesting more problems for the economy than what's priced into the credit markets and the stock market. So I completely agree with that. And I think one way you can square the circle, though, I think, is there is a view that the Fed's got this. So in the sense that if the economy were weaker than expected, the Fed could cut rates and the economy would come bouncing back pretty quickly. That there's not the kind of concerns about financial stability risk, or huge concerns that that households and businesses are well over their skis. I mean, I think what's different about this cycle is we're going into this slower growth period with household and business balance sheets actually in pretty good shape, and that's what's different. So the risk of sort of things breaking, I think, is a lot less. Now, sure, could something come in from left field? I mean, the thing I worry about is the Middle East. I think there's still a risk of a much broader reward there, and that could set the outlook on its head very, very quickly.
Yeah. Can I say I come from a household of warriors, so I share you there. There certainly can be something coming from left field. I also worry, to Bill's point, this touching faith in markets that the Fed can fix everything. Is a little overstated. And I think we need a better appreciation of risk.
Mm-hmm.
So we're getting audience questions in. I mean, one set relates to the pace of the Fed. Does 50 show that the Fed was behind the curve? What is your outlook for the pace in 2025? And what might be the test for pausing or going bigger to 50?
Well, Powell was asked about that at the press conference about what does the 50 mean, and does it mean you were a little late? And he didn't quite say yes, but he sort of acknowledged that if he'd known in July what he knew a few days later, they might have wanted to actually cut rates in July. And then, when I was, going back a number of weeks, I thought they should have cut rates in July. I thought there was enough evidence in the economy of weakness, especially in terms of the labor market and the strains on low and moderate income households, that the case for cutting in July was actually pretty strong, and the Fed passed. Now, what he also said, though, is after the 50 basis points, they're not late. So there is a notion of catch up here, that we're doing 50 to get to the right place because we didn't move earlier in July. And he danced around it, but if you read the press conference language, you can sort of tease that out.
Any views on what you're really, this relates to another question, but hard landing, soft landing, what are the things that you are looking at that will frame how you see the pace that the Fed pursues in 2025?
So I think what's happened is the whole focus has changed from focusing on inflation to focusing on the labor market. And I think the labor market now is going to get 80% of the attention, and inflation is going to get 20%, while 6 months ago it was reversed. And the reason for that is the Fed, as Powell has said, he said at Jackson Hole, he said it yesterday, they don't want any further deterioration in the labor market. So if there's further deterioration in the labor market, that's going to do two things. It's going to make the Fed go faster, and it's going to also make the Fed feel maybe we actually need to be more aggressive in terms of how far we're willing to go to support the economy. If you look at the Fed's summary of economic projections, they have the unemployment rate going up another 0.2%, which is pretty trivial. And then after that, the unemployment rate is pretty stable over the next couple of years. That's a soft landing story. So my view is focused on the labor market, because that's going to tell you the story about how fast the Fed goes and how far the Fed goes in the end.
But isn't that entirely appropriate given the dual mandate?
Absolutely.
I mean, when inflation was high, your best contribution to welfare was getting it down. When you're closer to goal, and then you really do have to worry materially about the labor market.
Oh, I'm not criticizing the Fed. To me, this makes complete sense. This is why I changed my view on the Fed. Like 8 weeks ago, I was in the higher for longer camp for a very long time, and then I saw sufficient weakness in the economy that made me feel that the risks to the growth side were now more relevant than the risk to the inflation side. So there's two aspects of why the Fed is cutting rates. One is because they feel that the dual mandate goals are in better balance. But the second reason why the Fed's cutting rates is I actually do think they think the risks to the labor market are greater than the risk to the inflation side at this point in time. So there's also a risk management element in terms of their approach.
Though that's not what he said yesterday. He said it was in balance.
Well, take a look at the summary of economic projections in the back where they talk about the risks, and it's there to see that the committee does worry much more about the risk to the labor market now than they do worry about a bad surprise on inflation.
Is the Fed too data dependent? Coming back to some of your forward leaning thoughts about where the Fed needs to head.
Well, with the economy growing, 2.5%. That's a pretty sustainable growth rate. And so, it's not like the data is telling you that, oh, gee, things are, the wing of the plane has just fallen off. So I think, you're sort of monitoring whether you're still on that sort of, glide path. So I think you do want to be focused on the data. But, you're absolutely right. I mean, if things start to change where the Fed gets the idea that the dynamics of the economy are quite, much less stable, that the labor market could deteriorate much more harshly, then I don't think you can just be looking in the back, looking out at the rearview mirror where the economy has been. You have to start to think about what are the risks going forward.
There's one question. I just throw it out there. Whether there's a case for asset market pricing run-ups without or before getting to the dot plot trajectory.
Yeah, it'll be interesting to see how the markets react to, the Fed over the next, coming weeks and months. I mean, I think, it's not really surprising that the market reacted favorably to what Paul did yesterday, right? He did maybe a little bit more than what was expected, but he also painted a very benign picture. you know, we're on a great trajectory. He kept talking about how good the economy was. He talked about how they weren't late. He talked about how we're going to continue to ease monetary policy. What's not to like from the market perspective? I think the problem is that the Fed's not infallible. They're fallible, and we saw that back in 2022 in spades. So the notion that the Fed necessarily has this, well, that really depends on how the economy actually unfolds. So I think maybe the market is maybe too confident in the Fed's ability to handle preemptively anything that sort of comes along.
Especially given how risky the world is. And indeed, when you think about it, the press conference was chock full of wonderful snippets if the wheels fall off the bus. Hear Chair Powell talk about how good the economy is, juxtaposed to the next employment report. So I think that's a risk.
Well, let me ask Sonal and then Bill a question, just following up on that, Vince, which is like I'm seeing nowcast forecasts of like 3% growth. Consumption's holding up. How do you square that with your labor market concerns? There seems to be somewhat of a disconnect there.
So if I can, I would just say that, look, the labor market is weakening, but it's weakening from a point where we were at 60-year tights. So in terms of how strong the labor market was. So to me, I recognize the labor market is weakening, but I'm not seeing it in consumption. I'm not seeing it in demand. Demand remains strong. So I totally understand the case for normalization, but I actually think Powell was exactly right in not talking up the economy, but recognizing that the economy is in a pretty solid place. It's in a solid place. It was the reason why, for me, 50 probably not, just because of the signage, right? The concern that markets get ahead of themselves, because if markets do, there are wealth effects. They do count. Financial conditions do ease, and then you throw in fiscal. And I don't see the obvious trigger for massive labor market weakness right now. So I tend to be a bit more cautious in terms of where the Fed may decide to pause or stop. I don't think we go all the way to 2.9 as the market anticipates by the end of next year. And I do think 3.75 to 4 is much closer to where the economy's neutral is right now, which means there's scope to cut, but not as much as either the Fed or markets currently believe.
Yeah, I agree with that. I think actually Powell agrees with it. I mean, he was asked about the R-star yesterday, and he said, "Well, we don't really know where it is," but he also said he thought it was considerably higher than it has been over the last 10 years. I mean, let's just look at the Taylor rule. What's in the Taylor rule historically? It's 2% real short-term interest rate. So that's way north of what the Fed is assuming. I mean, that's above the top end of the most hawkish person on the Federal Open Market Committee. And at the end of the day, R-star is about the interest rate that equilibrates savings and investment. And when I look at the economy, I see savings pool being depleted by large fiscal deficits, and I see investment being stimulated by things like the CHIPS Act and the infrastructure spending bill. And so I can sort of see lots of things that suggest that maybe R-star should be higher. The other thing I think is interesting, and Vince asked this question, I didn't answer it earlier, is what about the term premium for the bond market? Historically, the spread between 10-year Treasury bonds and short-term rates has been about 100 basis points up till about the great financial crisis. And then following the GFC, it was basically roughly zero. Are we going to see a return of term premium? And I think there are some arguments for having a higher bond term premium. The first argument is that we're far away from the zero lower bound. And so this idea that you hold bonds because you're worried you're going to be pinned at zero and the Fed has no ability to stimulate the economy, that seems to be much lower risk when we're starting from 5.25 to 5.5 on the federal funds rate. So I think, and the second reason I think it's just the fiscal risk. There is a fiscal risk out there, and personally, I think you should be pricing that. And at some point, this issue of fiscal dominance, where the budget deficits are just so large that the central bank is, essentially backed into a corner where raising interest rates just make the deficit bigger. Not a great place to be. I mean, I take a lot of comfort from what the Bank of England did last year, in the sense that they basically, the UK government wanted to do something imprudent on fiscal policy, and the Bank of England said, no, we're not going to accommodate it, and the UK government backed down. But you can imagine a place where the central bank is put under considerable pressure by inappropriate fiscal policy.
So you must be quite concerned about future prospects for Fed independence, and certainly if one candidate wins the presidency.
Well, I think it's harder to, undo the Fed's independence in one term, right? Because, the governors, the board of governors turnover relatively slowly, and the president's turnover even more slowly than that. So a president's probably only going to be able to appoint maybe 2 governors, and the president doesn't even have authority of how the presidents get appointed. It's a 2-key approach. The board of directors of the Reserve Bank, and it's subject to the approval of the Fed. I also think that that candidate Trump's view is really an outlier. I think there's a pretty strong sense on both sides of the aisle that independence of the central bank is a good thing. And this is borne out by the fact that countries have better macroeconomic outcomes when the central bank is independent, because the central bank then can take a longer term view of what's appropriate in terms of monetary policy. So I think that's pretty much the conventional wisdom. I think the Democrats are much more respectful of that. And when Bob Rubin came into the White House in 1993, he basically sort of set in place this new regime that we're never going to say anything critical of the Fed. And it wasn't because they're trying to be nice to the Fed. They changed the regime because they understood that being critical of the Fed just puts markets on edge. It increases risk premium in markets. And so it's, at the end of the day, it's actually counterproductive to what you're trying to accomplish in terms of having a stable macro economy.
But you do get that pressure, maybe not from the White House, but look at Senator Warren, right? I mean, and that doesn't stop, because it's twice a year during Humphrey Hawkins. It's like a ritual hair shirt that the Fed chair has to wear, while one party or the other is going to beat up on the Fed. So that's still true, right?
That's one thing where I give Powell very good marks. I think he's been really, really good at just sort of tuning out all the political noise whatsoever. I mean, the very fact that they did 50 basis points in the last FOMC meeting before the election tells you how much that the electoral politics don't weigh in on the Fed. Right, because there was some speculation that you couldn't do 50 because it's the meeting right before the for the election, and I think Powell said it very clearly at the press conference yesterday. No, that's not how we set monetary policy in the U.S. We do what we think is appropriate at the time, regardless of where we are in the election cycle, and I think he's handled that very deftly.
Let me shift gears a little bit. You mentioned that in the framework review, the Fed will need to think about quantitative easing and quantitative tightening and how it's been done. So I guess we're now in an abundant reserve place. The Fed wants to go to ample. So is the Fed doing this right? And do you believe that the Fed now has better tools and can cope with a 2019 repo market scenario or a dash for cash scenario?
Yeah, I mean, I think there's a couple of things that are different. One, you had the 2019 scenario, so they're very, very much, they're going to be much more cautious this time. They're going to stop before they think they've actually transitioned from abundant to ample. They're going to make sure that they have a bigger margin for error than last time. And the second thing that's different is they have a standing repo facility in place that if reserves were short for whatever reason, banks can go to the standing repo facility, and that would allow reserves to expand, just sort of naturally. If I was a bank and repo rates were to spike, I would definitely go to the standing repo facility. That's what it's there for. So I don't think the standing repo facility is stigmatized like the discount window is. I think it's available, and it's essentially a safety valve that didn't exist last time. I think the issue about quantitative easing and quantitative tightening is there needs to be a cost benefit analysis about when you stop. The Fed kept doing quantitative easing all the way up until March 2022. It wasn't obvious that that last $1 trillion of security purchases, really accomplished anything. And clearly there were a lot of costs associated with that, because every dollar that the Fed bought during that period, they had to fund at the federal funds rate. So they had a big interest rate mismatch, and that cost the Fed a lot of money. And I think that needs to be sorted. And it's pretty interesting to me that there's really been no real discussion about, how do you weigh off the potential fiscal costs or risk of quantitative easing versus the benefits in terms of providing more stimulus to the economy.
It's actually really interesting, this question. Sorry, Mark.
Please go ahead.
No, this question of quantitative easing is something which I find particularly interesting, because I will say, for many in the market, the assumption is at the first sign of even a bog standard recession, the Fed is going to jump into QE and all of these unconventional tools, which I think is a very frightening thing to be, because essentially that liquidity pours into into asset prices, and even if it doesn't hit inflation, it does hit inflation of asset prices one way or the other. So it would be fantastic if during the review the Fed made clear that it wasn't a go-to, it wasn't the first line of attack. Some standard monetary policy instrument was the first line of attack. It wasn't that they were going to start essentially buying government bonds as the first place to go to for easing.
I think the Fed's view is basically, for monetary policy purposes, you only do QE because you're at the zero lower bound for interest rates, and that's the only way to provide stimulus. What was interesting about this cycle is the QE started not because they're trying to make monetary policy more stimulative. It started because of Treasury market dysfunction, and then it just sort of morphed into more standard monetary QE. But the Fed never really sort of explained that transition or the motivations for that. So I think I just like to see a little bit more of a framework around QE and QT, given that it is now a tool of policy when you get to the zero lower bound for interest rates. I think the other thing that's probably important here, though, is the Fed has been very concerned about the zero lower bound for some time. After they looked at the Japanese experience, and they saw what happened after the great financial crisis, and then during COVID we got to the zero lower bound again. I personally think that when we look back 20 years from now, we're going to find that those experiences were actually exceptional rather than the norm. And I think that this idea that we're necessarily going to go back to the zero lower bound again anytime soon, I would be skeptical about that.
So would I. I have full agreement there. Yeah.
The just one question that we got in relates to this. It's a bit backward looking, but why did the Fed keep its foot on the accelerator after in 2021, early 2022 period, when inflation and the economy were moving?
Well, they boxed themselves in. Remember, they said they had in their framework, the way they operationalized their 2% average inflation target regime was in a very particular way. They said, we're going to operationalize it by we can't raise rates until we're at 2% inflation, full employment, and we're confident that inflation is going to go above 2% in the future to offset past misses on inflation to the downside. And then they compounded that by saying, we're not going to end QE until we're confident that we're pretty close to this point. So they kept the foot on the accelerator sort of on purpose by design, when it probably wasn't appropriate, because they essentially were fighting the last war. They're fighting the war of economy that was weak coming out of the great financial crisis, inflation was low, and the reality was the war coming out of the pandemic was completely different. So I think you want to have a policy that's set up that can respond to risk on both sides of the distribution rather than one side of the distribution. And I think that's I think they're going to make that adjustment when they do their monetary policy framework review. But don't hold your breath for big changes. The first monetary policy framework was from scratch essentially. This one is like looking at what we did, and so there's going to be modifications to the framework. But I expect to be disappointed by how much they do.
Thank you. I was reading Cicchetti and Schoenholz's piece on the framework review, and they very much emphasize this point that the strategy should be more symmetrical and emphasize preemption. just as you did. Well, we are coming to the end. Let me add, the Fed has to pay a lot of attention to financial stability. There are major potential financial stability risks out there. Both of you, I'd like to ask you, like, what's your take? How concerned are you about financial stability issues these days?
Well, you always have to be concerned because of the things that you don't know, don't see, and I think, the growth of the non-bank financial sector has been enormous, and we don't have a lot of transparency about what's going on there. I think, that said, I feel a lot more comfortable than I did, 10 years ago, 15 years ago, because I look at the GFC, it's sort of like a forest fire that burned all the dry tinder and provoked a big reaction in terms of more capital, more liquidity, central clearing of OTC derivatives, migration of LIBOR to SOFR. So a bunch of flaws in the system got fixed because of the great financial crisis. Now, I'm sure we're going to invent new flaws over time, but the fact that you had this major conflagration in the great financial crisis means you probably don't have as many vulnerable structures. But the non-bank financial sector is where I would be focusing my attention at this point.
More so than the Basel Endgame?
I think the Basel Endgame. I think the big banks, the problems that we saw in the banking system in March of 2023 had nothing to do with the capitalization of the largest banks.
Right.
Period.
Fully agree. I could not agree more on that front. I would actually just add in a minute, to me, if I look at the financial system right now, it's not the last war, which was leverage in the system. It's actually the concept of a monetary overhang. There's just a lot of liquidity. When there is a lot of liquidity, I think the risk of having bubbles, which is a first order problem, as long as you don't get into the derivatives of the bubbles in some sense, so it might be a bit more contained, that risk goes up, and I don't think that's going away because the overhang is just that big in terms of what's out there. So
good. All right, well, we've pretty much come to the end of the hour, and if I started asking new questions, we'd be here for a long time, and you guys have day jobs to get back to. So I just want to thank Bill Dudley for kindly joining this discussion today and leading us so well. I want to thank Vince, who had to leave a little bit early, and Sonal for fantastic job as discussing and offering good market perspectives. I want to thank the audience for joining us today. Thanks to the Bretton Woods Committee and thanks to OMFIF. So and I wish everybody a good day wherever you are. So thank you very much.
Thank you so much.
thank you.